Um, no, we've always considered that pandemic-related health developments were one of the downside risks that we have to consider to growth. But one of the things we still think is unlikely is the kinds of prolonged, very widespread lockdowns that we saw last year and the year before, earlier this year and last year. Reason being that there are a lot more public health management tools available that had either just been developed at this time last year or didn't exist at all. So no, absolutely not. And I mean, the other themes of our report talking about the increase in debt, the importance of next generation EU are still as relevant today as they were when we published the report last week.
Is the expectation then that we may continue to see debt levels rise here as governments try to figure out how they need to respond at this stage to this new wave?
If governments need to use their balance sheet to intervene to support the economy, then that would be something that would delay the stabilization or reduction in debt loads in Europe. But again, I think that's jumping ahead quite significantly because it's not really clear that governments would need to engage in the kind of very large-scale intervention to support the economy that they did in 2020 and earlier this year.
Sarah, I have this question a lot, and I bet you have this existential question over at the rating agencies all the time as well. Does it matter anymore about debt? And I'm not trying to be pedantic about this, but the fact of the matter is, you at the rating agencies and everyone else have been talking about debt levels as mattering forever, and nowadays it doesn't seem to matter really, especially when you've got Paolo Gentiloni trying to canvass opinion about whether we should just rip up the old Stability and Growth Pact as well. And then I look at your own charts with Greece expected to be up 191% or 291% debt to GDP next year. Italy will just be pottering along at 149, Portugal 122, Spain 118 as well. Do these levels actually matter anymore because of this Japanification we're seeing?
High debt levels do matter. I mean, what you've seen in Europe is an interesting trend of increasing debt, but actually improving debt affordability as more expensive debt rolls off and is replaced by cheaper debt. However, low interest rates will not stay around forever. We think that is finite. And the larger a country's debt stock is, the more vulnerable it is to any increase in interest rates. Now, I should say that if you have some demand-led, very strong demand leading to inflation, which causes central banks to have to hike rates, that is a different story, and that's not necessarily a negative thing. However, if you see significant increases in interest rates, the countries that are more vulnerable to that are, of course, those countries with the higher debt loads.